Good morning, ladies and gentlemen. I was wondering if there was a bar open outside somewhere because we have such poor attendance in the hall. You've got a bunch of stalwarts here to talk about the road ahead as far as private equity investing in India is concerned, specifically buyouts. So I would imagine that this is going to be an interesting conversation. So perhaps we could encourage more people to join in. But it's great to be here back again at the IVCA annual summit to talk about what investing and the investment climate looks like. We've got a great bunch of people here. I'm going to time them appropriately so that we can get more of a conversation going. We are going to link the macros with the micros as well and talk about each of their businesses individually, as well as the kind of dry powder that they're sitting on and what they intend to do. Why are we talking about buyouts? Because buyouts have been part of the investment strategy for men like we have here on the panel over the last several years. In fact, over the past decade or so, we've seen an increase in the number of buyouts. And, 2022 was a record year, and we've started to see an improvement after a little bit of a lull. We've started to see an improvement in 2024. The sectors that we are seeing controlled deals or buyouts happening in: IT, ITES, healthcare, manufacturing, retail. There's a whole bunch of them. Manish Kejriwal, I'm going to get you to start with the macros. As we look at 2025, let's first talk about the global trends that could shape investment strategies in India. Your time starts now.
Thanks, Shereen. Great to be here. Good seeing you again. I think a month ago when we were all in the Alps, the two themes or two topics people talk about was Trump and AI. And I'm just saying that because I think while that's not an investing theme, what the two of those things happen will really influence a lot of the global investors going forward. I think going back to global trends, if you look at it from the perspective of GPs, it's been an interesting year, 23 and 24. I think the biggest takeaway, if we went back to the Investor Council that we had a month ago, was a real lack of DPI and money going. So there was a significant shortage of liquidity, money being returned by GPs to their LPs, which is not good news, given the state of the markets. And because of that, a lesser degree of investment by global LPs into the asset class because there was a lack of liquidity. I think India is in a very different place. I think we're in a secular uptrend, barring the early stage VC when there was a slowdown given what happened 2 years ago. I think we'll see that come back, but if you see this as a representation of the dry powder, even all of us, despite being price disciplined, are stepping up and paying and acquiring assets where we have a high degree of conviction. But the bar is that much higher. And what's helping us is the DPI story out of India, which was a disaster 15 years ago, is today the one thing which is most appealing, not only vis-a-vis the rest of Asia, but as far as the rest of the world, because we have exactly booming IPO markets, which has been actually the exit from the majority of all our positions. But in addition to that, a significant amount of dry capital, as we said earlier, for sponsors, and India being globally relevant, whether it's China plus one, given what's happening to the Ukraine and the Middle East, it seems like even the strategics are refocusing on India. So exits, IPOs, of course, but in addition to that, the financial sponsors, because of all the dry powder we have and because we believe in India, and in addition to that, the strategics. So as a promoter or a GP which controls an asset, our exit options for the first time are multiple and very attractive.
Multiple and very attractive. And I think that has been the change as far as the story is concerned. And we've seen that accelerate, especially in the last few years. Vivek, let me come to you to draw the macros and the micros. And let me start by asking you about the global outlook first, before we talk about India specifically. To take forward what we heard there from Manish, what will be the trends that could potentially shape investment decisions and investment strategies globally, which could have an impact and a bearing on India?
Well, thank you, Shereen. That's a terrific question. Since we're talking about buyouts, to be specific, I think there was a panel earlier where we had a bunch of LPs on.
You're going to have to move the mic a little bit higher.
A bit closer? Yeah. Okay. Is that better?
Yes.
We had a panel earlier where we had a number of LPs on, and I think David Lowe and others talked about this. What happens in the US matters for what happens in India, right? And I think there are probably three things I'd highlight. Number one, if you just look at where buyouts have gone in India, there's been increasing concentration from about 55% to 75% into three sectors: financial services, IT, BPO, and healthcare.
Yeah.
And we suspect that will actually only continue to increase for very important reasons. These are often family-owned. They're often available for sale. You're effectively buying out other people's equity and capital. They often don't require cash, as much cash for growth, other than M&A and platform opportunities. So that's one trend that we definitely see persisting, is companies who produce great cash, whose balance sheet can be well managed, and whose equity stakes are available for sale. Those three sectors offer a lot. The second is, we actually do believe that the risk-reward returns for buyouts, and all the LPs do understand this, risk-reward has really favored buyouts over the last cycle.
Okay.
What you'll find is, if you look at large growth, large buyout, small buyout, pipes, and other forms of, effectively what you'll find is that on a risk-adjusted basis, buyouts are outperforming. And it's fundamentally, our belief is because buyouts help you reduce beta in many specific ways, not just how you allocate, not just governance and how you allocate capital, but it also allows you to control exit timing. The third trend, and this is where the US, by the way, people are nervous in the US about this, and in India, hopefully the party will continue, is if you look at buyout specifically and the MOICs, right, on exit, buyout to other sales to sponsors for buyout companies delivered about a 2.8 MOIC. Sale to public markets at the time of IPO, 5.1. And sale to public markets a year following, 4.8. In other words, a huge amount of the outperformance of buyouts has been route to exit, and that is dependent on how buoyant the capital markets stay. And that's something actually in the US, which has actually been a little more muted.
Yeah.
So as long as the IPO market stays open, we should continue to see great exits.
Well, Mukesh, I want you to build on what we just heard there from Vivek. Do you believe that the party is likely to continue? And again, linking the macros and the impact that the US could potentially have on the way deals are done in India, what would your take be?
I started in Indian private equity 20 years back, and I remember my first deal. That time, if you go back in 2006, people used to pay premium to buy 5% stake in company. And if you ever told anyone that you can buy out a company and sell it in public market 100% of your stake,
they thought you were joking.
People were stated that we were joking. And, look, 20 years afterwards, majority of the deals are buyout. And I think as compared to when we have our global offsites where we meet SMDs in other countries, at least one thing great about India is majority of our deals are still primary buyouts, where we're not buying from other private equity firms. Matured markets like US, UK, Japan as well, a lot of it is secondary, where you're buying from other PE firms. So that story has just begun, and a lot of founders have become mature to see what value is being created by especially firms like us and others, and the ability to attract talent, the network which we bring to place. And I think this is where this is just a start, and I think next 10-15 years this story will. Today Blackstone AUM is $50 billion.
Yeah.
Just to give you a perspective, we are the top 10 business house in India, which was the firm which has been started only 20 years back. So, and I'm sure that this trend will continue and PE will dominate a big part of Indian market.
You talked about AUMs of $50 billion and the 20-year journey that you've had in India, and the point that you made, and I think a lot of people recognize and acknowledge it as well, that the India story was almost likened to the Chakravyuh in Mahabharata, that you could get in, but you didn't have an exit strategy, you didn't know how to walk out, and now that has been validated and that is much more real. But if I can just ask you to build on what next now? You talked about what you currently have in terms of assets under management. Will the strategy continue to be buying out, or do you also intend to build in India? Because that has also been part of your philosophy and your DNA of wanting to do business in India. So is buyout the preferred route, or also building in India for you?
In our firm, our strategy is very clear. Don't buy what you can't build. Gone are the days where, you buy low, sell high. We have enough smart number of people who know how to value businesses, and gone are the days where returns are just made by buying something cheap. It's a very, very competitive market out there. And bulk of our returns have been always been through actually growth in the companies. Let me just give you some examples, right? Dara Housing Finance, a company which we bought, it was on the brink of bankruptcy. In 5 years, the profit has increased 7 times in that company. Taskers 6 times. Care Hospital, a deal which we did 1.5 years back, it was not even the top 10 hospital chain in India. Today, it is India's second largest hospital chain. Sona Comstar, not even a top 20 auto component company of India. In 5 years, it's a top 5 auto component company of India. 70% of the returns are driven by EBITDA growth. And unlike global markets, you don't have leverage where you can lever the companies a lot and make a returns on that. So the primary drivers of returns is growth. And as you know, Indian markets are at a rich multiple valuation. So from here on, unless you build a business, unless you drive revenue from your portfolio companies, unless you have CXO changes, you can't deliver those kind of returns.
We'll come to valuations in just a bit and whether this is a buyer's market or not. But Deepak, let me understand from you, your plans on how you see the global environment and what that could potentially mean in India. I know that you believe that you've only just gotten started in India. This is a landscape that is ripe with opportunities and possibilities. Take me through what the India story to you means today.
So let's start with the global allocation, right? So broadly, global allocation, there would be a bias towards US. There would continue to be a bias towards US. There is a lot of volatility associated with US, but that's a market that would continue to outperform. Focusing on India, I mean, this is our core market in Asia. We have a multi-asset class view here: infrastructure, private equity, late-stage growth. And I think infrastructure has started to mature for us a little bit. Private equity and late-stage growth have only just started. I mean, a lot of people, when they look at us, they look at, broad pool of capital. But what they don't understand is a really large GP. Almost 80% of our assets are managed in-house, especially in India. Last 9 transactions that we have done have all been direct. That doesn't mean we don't partner with our partners like Dara. We continue to do that, and that creates a right to win. But continuing on across the 3 sectors: IT services, financial services, healthcare. Healthcare, the journey's only started, right? Like he's talking about like being a second largest chain, but the reality is in India, corporate chains are still 12%. So corporate and regional chains like Sahyadri, which we own, are only 12% of overall hospital beds. So it's a multi-decade consolidation journey. And there are several such multi-decadal journeys that are existing in India that we'd continue to focus on, drive, and move forward.
Well, those multi-decadal opportunities I'll just get to, but you were talking about Dara and your partnership, and that's actually how you started in many ways in India. But this journey of actually partnership to co-investing to now looking at buyouts as a way forward in India, what's been the biggest lesson through the last many years that you've been operating here in India?
Many lessons, right? We started off, as you said, with Dara. We had anchored Dara.
The maiden fund, if I remember correctly, yeah.
Back in 2012, 2013, we did our first co-invest with Dara, which was Pandana. I always joke that that was a proper welcome to India. I mean, you can look at the media, all the things that got played out, and we had to manage that through and understanding how do you operate in an Indian mindset, and that was a control transaction. And still there was a lot of pain. Like there was other issues that we continue to evolve in India. I think you take a massive step back and you say, what is the most important thing that drives returns in India? It's governance, right? Pick your counterparty right, get the governance overall right, and then have operational mindset to build a business, take a long-term view, and you'll make money. India is not a top-down market, it's a bottoms-up market.
Yes.
Boring. You're looking to cut me off. So.
Yes, it is a market that also requires a fair degree of patience, but also appetite for risk as well. But Sumeet, let me come to you now and talk about your journey here, specifically from a buyout perspective. How do you see India? What's the outlook for 2025? Do you expect 2025 to be a significant accelerator over the previous year? What's driving the needle today?
Yes, so I think as a firm, we focus on mid-market buyouts, buying businesses which are usually $5 to $30 million in EBITDA and less than $300 million in enterprise value. I would say over a 10-year period, the supply of businesses that are available for sale has exponentially increased for multiple factors.
Right.
Being succession planning, spin-offs, global firms looking at partnerships in India. And also, there are two key themes I think that we have worked on. One is the global partnership model. I think a lot of Fortune 500 companies to succeed in India sometimes appreciate having a local partner, and we have done it 3 times over with Iron Mountain, Yum Brands, and Amazon. And the other theme, which is a very proven playbook in US and Europe, is consolidation of fragmented industries, where industries are fragmented, but each player makes money because the industry structure is very disciplined. And there with scale, I think margin improvement to growth to upgrading management and eventually multiple expansion all plays out. So we have done that 8 times over. So I think that theme of lot of industries in India are still fragmented. I think that consolidation play opportunity will continue. And with public markets getting little subdued compared to 24, I think there is a pool of businesses and shareholders which are looking for liquidity. So deal flow, I think in the next 12, 18 months should accelerate if public markets stay the way they are as of now.
Okay, so what's not particularly great news for the public markets might in fact turn out to be good news as far as the private equity markets are concerned, in terms of people wanting to look at the private equity route as opposed to the public market route. But on the issue of consolidation, because that's what you talked about, the fragmentation that we're seeing and the effort on the part of private equity players like yourself to play consolidator, is that going to be the big focus area? Will that be the strategic driver for you as you look at India going forward?
Yes, I think that is, I would say 50% of investments we do are focused on consolidation play, like the last 2 months as well. One in the insurance brokerage space where we have bought 2-3 businesses and we are amongst the top 4 players overnight. And similarly in consumer packaged food businesses, we have combined 2 businesses, one being Agrotech Foods and the other one being Del Monte. So I think the opportunity across sectors to consolidate, I think, is a very large one in India.
You know, Manish, if I could, the themes that I'm picking up from each one of you in your initial comments, one, of course, is family-owned businesses looking at ways of exiting at this point in time. The next generation perhaps doesn't want to be, doesn't necessarily want to get their hands dirty, wants a way out. Consolidation and, fragmented sectors being put together. That's another theme that seems to be playing out. Global companies looking at India from a local strategic perspective. That's the other theme that's playing out at this point in time. If I were to ask you about valuations, because that oftentimes is the impediment, is this a buyer's market today? I mean, you've been cautious about this. Are we looking at deal flows from a buyer's market perspective?
Shereen, I think if you look at what was clear is the time gone by. So when I look at 24, it was definitely a seller's market. We had IPO markets which were crazy. We all got exits. I think each one of us, we had more than 4 IPOs. We still have another 3 in the... It's gotten tighter now. So when it's a seller's market, buying was very difficult last year. So, of course, each of us has teams that are motivated by making new investments and exits, but the focus was on driving exits, cash, and DPI. Of course, our teams, I mean, deals don't happen overnight, as you know. It takes years to get a deal done. I would say we did do 2 or 3 deals last year. We normally would do 5 or 6. So the rate of deployment slowed down.
Do you believe that it's likely to slow down further or pick up?
Yeah, so my sense going in the past was, despite that, we did stuff, you had huge conviction. So you pay a higher price, the amount of margin for error goes to 0 or close to 0. So your level of conviction, you spend a bit more time. I think going forward, what this has done is, and I would say definitely for us, I would guess Mukesh and of course, OTPP and our other friends with Sumeet, our pipelines are extremely strong, right? So we have 20 things in the hopper, which we've been working for more than a year. I do think the public markets eventually are an indicator where the private markets are going to go. And it hasn't been the most healthy start to a year. I think prices rightly will correct. The multiples will compress. And the second half of 25 will be a buyer's market much more than a seller's market.
Okay, so Mukesh, let me understand from you, how are valuations looking at this point in time? Are you also holding back or sitting on the fence, waiting for things to turn as far as valuations are concerned?
I think if you look at India's valuation, on the large cap side, in fact, we are below long-term averages. So on large cap side, it's fine, but I think the frenzy which happened in the mid cap and small cap, primarily driven by large domestic inflows. Our biggest competition actually for deals was public markets. It was not other PE firms, because we do only buyouts, and when we see the founders having a valuation which is 2x of what we are offering in the IPO market, it was very difficult to convince them. But off late, I think what is going to happen is supply is going to outstrip demand, and the supply of capital also in form of number of IPOs which are coming, and with this correction, I think I agree with Manish that second half is when, a lot of people who are looking, I know some of the IPOs have been pulled back. So it will not be as easy to do an IPO as it was earlier, and that was when...
pulled back on account of the volatility that we're seeing?
Volatility and I think the valuation what they had in mind.
The expectations,
Yes.
the mismatch in
Yes.
expectations between what the founders expect and what the market's willing to offer at this point in time.
Yes.
Sumeet, are you seeing that as well? Do you expect things to pick up in 25? And do you also believe that this mismatch of valuation expectations is perhaps going to see more IPOs fall or being a casualty to this misalignment on expectations?
So I think if you see globally, as investors sitting globally, still India is, I think, on the expensive side on
Yes.
a relative basis, what they are seeing. So I think the markets will be subdued. And I think to each seller, if people like, even in our business, if a business needs to be sold and we need liquidity, and we're getting 10% lower than what we want, we would go ahead and do it. And I see the same behavior from, other motivated sellers and buyers respectively. But I think it will be a little subdued environment seeking liquidity.
Vivek?
India's pricey. We know India's pricey. I think there are three lessons we've taken from it, just observing outside it, right? One is India's equity risk premiums is now getting back to a high, thanks to currency depreciation, thanks to other risks associated with it. And as a result of that, it's actually quite difficult to, even with buyouts, you need a 2 in front of your returns. You need a 2 in front of your returns, and anyone going out there raising capital who says otherwise is probably, is tricking themselves. LPs will tell you, you need a 2 in front of your returns to justify the prices at which you're buying. So that's one. The second is, look, we went from a regime of, paying 4 to 6 times, 8 to 10 times. Now we're paying 12 to 14 times. Guys,
Yeah.
we know what we're buying at. And therefore, what has happened as a result of that is people are moving to quality. You're better off buying a platform of higher quality at a slightly few more turns multiple that can use the thesis that Sumeet talked about or Mukesh talked about as a platform to acquire other businesses, as Care Hospital has, or some of the other examples, versus buying a fixer-upper at a great price. So this is not a market where you really want to end up buying a fixer-upper.
What does the pipeline look like? And I'll get each one of you. Do we have more fixer-uppers at this point in time, or do we have the high-valued quality bets? Mukesh, you want to come in on that?
For us, what we thrive is, what we state to our LPs also, we look for deal complexity with great businesses. That's what we
Deal
thrive.
complexity with great businesses.
Yes.
Okay.
Where there's a motivated seller, where there's a cross-border transaction. We bought VFS when there was COVID. We bought Care Hospital where there was a minus frivolous case going on. IGI where Fosun was the seller. So I think in those situations, as Sumit also rightly said, there's no option but you have to exit, right? And that's where we come in and move at speed and certainty to get this business in our favor. So, and if we see that we can create value, whether you pay, any deal, if you pay 10-15% higher, but if you have the conviction to create value, I think if you have to go wrong, you will go wrong even with the 10% lower value. So I think what we thrive for is deal complexity, and when we see that, we move at speed.
But let's address that value question and the value issue then. I mean, what are we talking about in terms of the kind of value that you hope to create, say, over the next 5 to 7 years? The returns that Vivek was talking about, that Sumeet was talking about. I mean, what should we realistically expect now in terms of value creation as well as return generation from an Indian asset?
I think our value creation journey will remain the same. like Emphasis was declining 20 quarters in a row. If I would have bought Emphasis even 10-15% higher or 20% higher, we would have made the, what returns we have made. And I think we got, in terms of IT services alone, we have got more than 50 clients from Blackstone portfolio. So I think whether that will stop, no, that will continue going forward. In Care Hospital, to Sumit's point, what you've done in insurance brokerage, we've done in hospitals. Again, you've created a platform. If you buy 10-15% higher, but the other platforms which you're, adding on to it, I think that will continue. And to Manish's point, yeah, after some point where you see the margin of error is too low for all right bets to go right, that's where you put a pause and say, let's wait and watch.
So it's not a pause for you at this point in time?
Not a pause for us. So I think personally, as I stated, IPO is a good way to start, but that's, it's not a good way to exit, right, finally. And especially for promoters of Indian companies, for markets have become quite matured enough for PE firms to exit completely in public market. But for founders, if they have to sell a controlling stake, it becomes very difficult to exit in public market. So at right point, I think this will move again towards private market. And for us, certainly, we see opportunities going forward.
This is a man with a listed company with lots of money to deploy. So all families in this room should be coming to him. And Mukesh is the man of the hour.
Well, there's clearly a side deal that's happened between the two of you before the start of the panel, Manish. But Deepak, I want to understand from you, what is going to be the allocation mix now as far as India is concerned? You've been a big believer in the India infrastructure story. Yep. Is that something that you continue to bet on?
Absolutely. I mean, we have 2 roads platform, 1 renewable platform. We'll continue to deploy. Our view on infrastructure is you put in $200, $300 million, get a platform going, and then you balance it out across vintage, right? Because you're not trying to have 23, 25% outcomes. In infrastructure, we're looking to have 13 to 15% outcomes, which you can create while driving nation building efforts. On the private equity side, I agree with what Manish and Mukesh have said overall, that the reality is, ultimately, there's a fight for quality. You have to be able to continue to build out a business. Like when we did Sahyadri, it required a lot of professionalization. Now you have to be able and willing to do that, but the ethos of the company has to be right? So it was a good company, great clinical outcomes with all the things that private equity can fix. We can go in there, and if we have conviction, we can drive things forward. What you can't do, back to the governance point, look at companies which are inherently broken from their overall ethos, and that becomes much harder, generally, especially in a whole period that traditional private equity would
you look at companies that are inherently broken, but you believe that you have the ability to be able to fix them, to take Vivek's point forward?
If it's a governance failure, no. If there's anything else, we can go fix it.
So, no as far as governance is concerned, but if there's anything else you may want to consider, you do have the appetite to take on that kind of a risk.
And we have continued to do that.
Okay. Manish?
No, my view on this is similar to Deepak's. Governance is truly a bimodal thing. Either you believe in it or you don't. But I'd go to one level deeper and I'll say, given we're in India and we have, at the end of the day, we need to remember, unlike Deepak's money, our money, Mukesh's money, we're a fiduciary for somebody else's capital. It's not our capital. And we have a limited amount of time. We need to return that capital. And given the complexities in India, Shereen, which you know better than all of us, you don't often have the time to do a full turnaround. So what we say is we would love to go into situations which are complicated, like Mukesh mentioned, but one where the balance sheet is broken, not where the P&L is broken. So we can do a capital recap and help improve the operation significantly. We have a bunch of really strong operating partners. But if the P&L is truly broken, we would like to do that. But believe we don't often have, we're often sort of tied down with the labor laws and other regulations where we would need more time, and it's risky because the worst thing you want is after 6 years of work, you think you need another 3 years and the IPO markets have collapsed and you're forced to sell a company you put so much effort in.
Right. Now, let's talk about the regulatory environment, because that was something that Vivek mentioned specifically with respect to the US. But many changes have happened here in India for the better, whether it's changes as far as the FDI regulations are concerned or, even as far as the IPO markets are concerned. Mukesh, I want to understand from you, how much is the regulatory environment now facilitating deal making, especially control deals?
I think at least one thing great about India is there's sanity in chaos. there's no surprises, and at least from our point of view, what generally as a firm we stay away from deals which have high regulatory compliance. And mostly, if you look at most of our companies, they are actually export-led companies with customers being abroad. And from that point of view, we have not faced, at least it's been a stable environment. I think the last thing you want is changes in, and off late, at least when I started 20 years back, every 1 year budget was a big thing. Every year we used to think that, oh, today something is going to happen and something is going to happen to one of our portfolio companies.
What, you didn't watch the budget this year?
Like last 3-4 years is almost a non-event, right? So, and that's what actually, at least we are long-term investors. We are not mutual funds. We are here for 5 years, and what we want is predictability. And that's what we have seen in the markets. Still a lot of things expected, which we have at least given recommendations, especially taking companies private in India. So many
So
companies.
that continues to be one of the big friction points?
Yeah, because India is, I think more number of listed companies than US, right? And so easy to take companies public, but now to take them private, it's a challenge. So there are still some changes to be done or some areas of improvement, but we are very happy in terms of predictability, stable government environment, and stable laws. So we're not feeling
So the climate is definitely predictable, even as far as tax is concerned, a lot more predictable today.
Even on the corporate side, even regulatory, be it, labor laws, etc., we don't see much issues.
Okay. What would you add to that list of things that you believe still require redressal? You talked about being able to take a company private. What would you add to that list?
I think there are some things we've already given recommendations to the government, but I think, yes, I think there are a lot of companies which should not be public, and, they can be done much better in a private environment. And if it's made easier to take these companies private, and, peace can be the catalyst to take them private, that would really help the corporate environment.
Sumeet, regulatory environment, predictability, to Mukesh's point, how enabling is it for buyouts?
So I think the environment has been improving, but a lot more to do. For example, I think one key pillar, a lot of investors in US would say, leverage is a very big component of driving returns in buyout. And I think the policy environment around banks to lend money for acquisitions, I think that was very contextual in 1960s and 70s when that policy was formed, and rightly so, that lend against projects and capex. But today, I think if I have to give a personal loan, would I give against proven cash flows of a balance sheet, or a greenfield project where I don't know where the government approvals will come? So I think contextually, on the banking side, ability to lend for acquisitions against a very strong balance sheet where EBITDA is proven, competitive edge is there, is something I think contextually, I think policy has to be completely relooked at. Even it will improve the quality of assets in a bank where they are lending against proven businesses rather than greenfield projects.
No, fair enough. Vivek, you want to add to that list of things that require attention at this point in time, and what you believe has changed on the regulatory side to in fact create a much more enabling environment?
That's a good question. Not much to add. I just make two very simple points. If you look at buyouts globally, you look at buyouts even in India, they actually tend to be, relative to the economy, more heavily weighted towards IP, where IP exists, and services, as a term, the IP and services. As a result, and those are two areas where, frankly, regulation plays less of a role, with the exception of protection. The second is that you're absolutely right. I think Sumeet is right. Availability of leverage. Although I will add one thing. India's relationship to lending and India's relationship has been appropriately conservative in one sense. You have to really consider carefully who you're lending to. Now, when you're lending to people who have a fiduciary responsibility to a whole bunch of other people, it feels a little bit different than when you're lending to a classic promoter where he or she are all in. And frankly, you have to think about this differently. So one question to regulators, how do you start to differentiate and make more capital available? Because that will attract more capital into the country for the growth that we need.
No, fair point there. But, Mukesh, I want to start by asking you, you talked about $50 billion. That's what you've already invested over the last 20 years in India. The target was to do another $25 billion over the next few years. So what's going to drive the investments? Are there any new sectors, any new themes that you're looking at, different from what you've been investing in?
Actually, for us, we are a very focused firm. We just focus on 5 sectors. And in these 5 sectors, we have a minimum deal threshold. So, anyways, we are very focused. Apart from that, over a period of time, we have another pools of capital also. So, like we have real estate. We'll have some point infrastructure fund as well coming in. And
How long before that happens?
So I don't want to comment on that, but yeah, we have whatever Blackstone offers globally will definitely be in India. Just to give you a perspective, Blackstone, India is now the best performing geography for Blackstone globally for the last 5 years in a row, and it's been talked in the...
that does deserve a round of applause.
Yeah.
Well,
So, it's the 3rd largest geography for Blackstone globally after US and UK. That determines the importance of India. And as we speak, March 20th is when we complete 20 years. Our founder, Steve, will be in India to have that celebration. So we are very, very bullish on India. And, you know, in this business, success breeds success. So more you deliver returns, more investors give you money to deliver more. So that's the problem we have.
so how much more money is coming your way now, considering the fact that you've delivered such stellar returns for Blackstone globally?
Money is never a problem for Blackstone.
What you do with it is probably the concern.
Yes,
but
thanks.
Deepak, let's understand from you in terms of the allocations already made, but more importantly, the appetite for growth from here on. You know, what are we talking about in terms of the dry powder that you intend to deploy in India?
I mean, look, we right now, OTPP overall is over $250 billion. We have roughly $5.5 billion in India right now, which is 2% of OTPP, which is too low, right? We have to at least first take it to our fair share of GDP and then continue to grow. India is like one of the large...
So why is it still at 2% of GDP, which you acknowledge that it is too low? What has been the speed breaker to your aspirations?
No speed breakers. I mean, we came here and opened our office in 2022. We have done over $2.5 to $3 billion of things since the last 2 years. We have started right now in the earnest in India, and we would continue to build from here. And as you have all said, it has been a net seller's market.
Yes.
So you don't want to deploy a lot of capital, right? To me, this is a multi-decade, back to my point, like we have to build India over the next 10 years, 15 years. I mean, there is a lot of history that Blackstone is going through, but there is also a lot of pain that has come through in private equity. We want to be disciplined, and we want to be very careful about where we deploy capital.
And I do want to get into the pain question as well, and get all of you to sort of talk honestly about that, because not everything has turned out to be a bestseller, not everything has turned out to be a blockbuster. Manish, I'll start by asking you, what do we need to be mindful of as we look at the story, as we look at the bets that are playing out, as we look at value creation as well as returns? What do we need to be mindful of? You know, where do you believe the pain could perhaps creep in?
You know, I'm going to take a different attack at this than I normally do, Shereen. I think for the industry, the 2 areas we should be most careful is one, hubris, because we seem to be at that point where we're peaking, and there's only normally one direction to go after this sort of a thing happens. I'm not belittling any of the successes of anyone on this panel, but I do think as an industry. And the second one is actually when I see the increased amount of fundraising. We're fortunate that some of us have had a level of success where there's been an ease. I mean, Mukesh said that. He can probably attract whatever money as Blackstone. Many of us have to spend a lot more time doing that. But the recent thing, whether it's the US or India, of really going mass market and retail and taking checks of 1 crore to, you know, much smaller ones,
yeah,
from what are not accredited investors in the true sense of the word, I've seen a level of mis-selling which I find shocking. And this is going to come back and bite us, given what the regulators are here for. So I think as an industry, we really need to be careful that the hubris doesn't get ahead of ourselves.
Are we peak hubris today, or is there distance to go?
I think that's individual, really. I'm not saying for the industry as a whole. I'm just saying forward-looking. And I think just to where you allocate capital, there's always going to be themes and sectors. For us, at Dara, it comes back to the team. Historically, we've been very successful in financial services and in retail. Retail, we just listed Vishal, which was blockbuster after 6 years of a lot of effort. We really made change. going forward, we've really bulked up the team in healthcare and services. We've got a superb guy who joined us. And on tech and tech services where we invested in the US. To me, the opportunities in India are limitless. The ability to play is driven by your team, your capabilities, and what can you bring to the table, which is different, and what's your angle. It's a bit to what Mukesh said about we take a complicated position and do the same thing is you've got to understand why you're in the market, and number two, whose money it is, and then deploy it.
No, fair point there. And Deepak, you know, that's what I want to build on with you as well. As you look at the opportunities, and to Manish's point, it's limitless opportunities in India today. How are you going about creating that differentiation? How are you going about creating your own investment thesis, your own investment strategy, building out the team here in India? And, you know, you're the new kid on the block, so to speak, having only started in 2022.
So, look, stepping back, I mean, we all have our own assets, right? Like for us, the asset is that we don't have a fund life. We have flexible capital. Right? There's no specific pool of capital that I have to draw.
So you're better off in comparison to Manish.
In some way. But there are other things that are beneficial for Kedar as well. So no comparison, but broadly speaking, flexible capital, our pool of capital remains differentiated. We can hold on to assets. That allowed us to do a lot of stuff in late stage growth, where they saw a solution capital to come consolidate the cap table before the companies are prepping up for IPO, for example. So that was one. I'll give you another example in Omega, which is our large RCM deal that we did end of last year, and we partnered up with GSAM. Our ability to partner up with our other GPs and founders wanting to work with us to drive things forward, we were able to disintermediate a competitive process. So finding angles where you have a right to win either yourself or partnering up with people is what we have been doing.
Sumeet, where do you believe you have the right to win through 2025 and the next few years? And in terms of the bets that you're likely to make, how different will they look perhaps in light of the experiences that you've had?
So I think continued building the muscle that we have built, which is mid-market buyouts, roll-up consolidation plays, global partnerships. So I think there's a business flywheel that we have put in place. I think we need to continuously strengthen it. And I think the opportunities are plenty, but staying disciplined and keep returning money by exiting, I think is a very important part of the puzzle as well.
You know, Mukesh said that this is a market that hasn't surprised anyone, or at least the level of surprises in the last few years have been limited. To Manish's point as well, in terms of pain, where do you foresee potential pain or existing pain that could upset the party, so to speak?
So I think India outside in stands for growth. It's the fastest growing economy. So I keep saying India is growing, industries are growing, but companies are not growing. Reason being, I think there is over competition in India. There are too many smart people in the
over
country.
Competition, we're talking about concentration risk. You're saying there's too much competition.
So I think I'll give an example. For example, paints industry. Aditya Birla Group has committed.
So it's a big boys fight.
So I think as I said, industry is growing, India is growing, companies are not growing. Because number of companies are increasing. I think in US, when incremental capital comes, it goes into AI, new innovation. In India, you see, oh, he's making money in that industry. Let me also enter that industry. So in India, we chase opportunity that already exists and keep destroying, I would say, profitability of a currently hugely profitable industry. That's a big difference I see between US capital allocation and India capital allocation.
The number of private equity. He's talking about the number of new private equity firms competing with him.
No, but on a serious note, you know, there is a concern over concentration risk in India, that it has become too much of a big boys market across different sectors. But to his point that you're seeing growth, but you're not seeing companies grow. Mukesh and Manish and Vivek, you want to get in on that?
I think in any industry, and I'm sure all of us do the same thing, right? What you first look at a company is what's the moat of the company, right? And every company has some differentiation. Some companies grow with the industry tailwind, and in IT services alone, we have like tons of companies. But still, what Vivek said, 60% of Indian buyout returns have come from IT services, where there are more than maybe 300, 400 companies. So what you have to see is whether you are the king of that micro hill where you're operating. You're not, you know, there are hundreds of companies, there are that TCS and Infosys, but still there are companies which are king of that micro hill in which they are operating. And, if you have that moat, you can still defend yourself, your market share and grow.
Is it easy to spot the kings of the micro hill, so to speak? Is it getting harder, Manish, to find those companies?
No, I actually have I'll take the question, the example that Sumeet gave, something like the paints industry today, right? And I would say it's one of those things which have blown out of proportion in terms of the level of how there was Asian Paints which made the returns have been considered for 30 years. For this period of time, you're going to have a competitive intensity which is ridiculous. For a private equity player like any of us, we looked at one option. We saw there was, all of us have probably seen it, there's a global seller selling an asset.
Yeah.
The current price makes
you can name them, it's public information, Axo Nobel.
But I'm saying the current price is ridiculous. So what do? You have the option of stepping out of that, being quiet, being silent, and coming back. Because
that's very hard for you to do, being quiet, being silent. Manish, what are you talking about? That's not you at all.
Thank you for that, Shereen. I got that feedback.
No, but Vivek, you wanted to make a point?
Maybe there's a slightly different angle on it. I think, I don't have a dog in the fight. I'm not putting capital to work, but we do look at this from a distance. There were three things, I think, on what could go wrong. Number one, and this is what went wrong in China in part. If the rules of the game change, people are out. The people will just hold back. And I think, thankfully, the rules of the game have not changed. That's one. The second is governance lapses. And the good thing is, for the most part, India has actually reduced those incidents of governance. And governance lapses, frankly, they're like anything else. They're like governance is the rule of rulers. And if the rulers don't play by the rules, nobody else will. Yeah. So that's another one. The third is, and this is a bit different, to Mukesh's point, you have to get out ahead. You're right. And Sumeet's point, lots of players identify opportunity and people go in. The only way to beat them is two things. One, operating capability. Operating capabilities, you look at the pace at which Blackstone or Samara or some of the other folks, including now Dara, have actually added operating partners. It's frenetic. And the reason is simple. We've gone from an era of operating partners being window dressing to actually getting their feet on the ground and fingers dirty and rolling up. And that, frankly, is the pace at which you roll out acquisitions on care hospitals will determine how far out ahead you get of somebody else's capital that happens to find that space interesting. So I'll just say that, at some level, buyouts have shown the way to developing operating capabilities, which is one way to basically thwart the risk of a lot of competitive capital coming your way.
I'm going to take one or two questions from the audience. Do raise your hands if you have one, and we'll try and get a microphone across to you. But let me get closing comments from each one of you, because I think we're pretty much at the end of our time. As we look at the India story, and I think everybody's talked about the opportunities that present themselves, how exciting it's looking, what it means in terms of a return perspective, etc. What does the India premium today look like? Mukesh, let me start by asking you.
I go to LPs, and every time they say India is trading at it's trading at 100% premium to UK market. It trades at 20 times P, UK market trades at 10, and they give example of China and they give examples of Korea, etc., which all trade at 10 times P. And my answer is, if you look at returns of India for the last 30 years, 20 years, 10 years, globally, all the markets, just take the returns of all the markets for 30 years, 20 years, 10 years. India, there are only two markets who have delivered double-digit returns globally, US and India. And all the other markets are low single digits. So even if you correct India by 15%, 20%, it will still outperform all the peers. So I think one great thing about India is the reason why the multiple is also high is the growth which this country exhibits and the stability of the government and the spirit of Indian entrepreneurs to even work in difficult environments and create value. Obviously, in mid-cap and small-cap, there has been a huge spike and there has been a correction, but I think the growth will continue and India will continue to trade at premium to other global markets given the growth it has.
Manish?
I think Mukesh has answered it well. My point is, when someone talks about the India premium, we should always, as we do with the LPs, remind them of the India growth. I mean, when you talk about a 6 or 7% terminal value in your models, people are shocked. I mean, how do you do that? So it needs a higher. I think the more important aspect is not everybody's made money in India, right? So at the end of the day, to Mukesh's point, I think you've got to trust the GP that you're deploying capital behind. It's not about riding the beta, it's how do you drive the alpha. Whether, as Vivek said, it's driven by your operating partners, there's an angle which has to be related. At the end of the day, this is a people business. You've got to get a bunch of guys who know you can differentiate, because otherwise everybody should be giving supernatural returns. So what I'm saying is, in a market like India, which is not cheap, there's a reason at the macro level why it's not cheap. But in order to really make money at a consistent level is very difficult. And I think one of the core aspects, which I think is bimodal, is what Deepak said earlier about the governance. So the only thing, we may or may not have made a lot of money, we luckily have. The one issue I take pride in is we haven't called a promoter wrong. We've never had a situation of theft or we've been very, that I think is critical. And I think given where markets are, people are also realizing it's better to show the extra $10 on your P&L rather than taking out somewhere.
No, I think the governance premium, that point is well taken, Sumeet. The India premium.
So I think on a normalized basis, I'm not taking a static view of a particular quarter. On a normalized basis, I think it has sustained over the last 20, 30 years. I think on fundamental NPV Excel sheet basis, I think it is justified. Second, I think it's the same Fidelity Wellington investor sitting in, overseas buying Suzuki stock in Japan and Maruti Suzuki in India. Yeah. So it's the same buyer who's pricing it differently. So I think it is justified. But the job of private equity is, when I buy something in UK or US, I have to sell into that market of, let's say, 15 times earnings. So I think our job is, can we buy cheaper than what is public market, do and improve the business and sell into that market. So I think in that sense, our job is more, can we sell into what is a justified market and buy cheaper? And same, I think the counterparts in UK and US has to do that.
And if the market allows you to buy it cheaper at this point in time, that's the question. But anybody here with a question, we'll quickly try and get. Yes, there's two hands there. So if you can, in the blue shirt, stand up, that would be great. Maybe come up. Yeah, the mic's coming across to you.
Thanks everyone for the insightful session. So we had just had a discussion saying that, the pain in the public markets is good news for, VCs and PEs, right? But, one of the sessions in the morning, it said that, India will also have a record IPO year in 2025. So it's kind of sounds like, two different sides of the same coin. So can we reach a consensus here,
Can we reach a consensus on whether this is going to be another record-breaking year for the IPO market, and what happens as far as the private markets are concerned as well? Who wants to go first? Sumeet.
So I think we have two set of activities in our business, buying and selling. If IPO markets are great, we will focus on the latter. And I think if markets are subdued, we will focus on the former.
Fair point. I think that pretty much answers your question. Yes, sir, you had a question?
Super quick. If the gentleman here can give an advice to a young emerging manager stepping out, raising funds for India, especially for Tier 2 and Tier 3 cities.
That is the perfect note to close this conversation on. So thank you very much for that. Let's start, Mukesh. Young manager looking at raising funds specifically for India. What would you tell them?
I think also one point we missed. What has driven returns of everyone sitting on this table is not us. Is actually the CEOs and entrepreneurs which India produces, which is ruling the world, but also the bulk of the returns are coming from New India, where all the CEOs, be it in MNC or be it some other Indian company, are coming to private equity firms, becoming entrepreneurs but professional managers and driving the change. And that's what driving the returns. And just to your question, I think this is the best time to enter India, because I'm sure what you're seeing in the market, there may be some more. I'm no one to guess what's going to happen next 6 months, but maybe there may be some more correction. And I am a strong believer that, as I stated, if you take a 20-year, 10-year or 5-year view, this market over the next 15, 20 years will again outperform all the global indices. Everything at macro level looks good in India. When you divide any number by 1 billion, it looks good. But it's all about micro, as Manish stated. So pick your right bets. If you're doing a minority, pick your right partners and drive value creation. That's what will create returns.
The outperformance is expected to continue. Deepak.
I mean, look, if you look at the private equity market, I mean, it's been very skewed in terms of overall performance, and there has been fight to quality, right? Deliver consistent performance. Consistency is the only thing that would drive things forward for you. Figure out a way to demonstrate what you have done, what you have delivered on a consistent basis, and that would drive things forward. Like we have seen now, the market has concentrated into a few large players, especially the Indian managers. There's a lot of competition, so you need to know what your edge is, you need to know what your access is, and you need to be able to drive performance.
Thank you very much for that question. So I'm going to end, Vivek, I'll start by asking you the thing that gives you the most confidence about India and the one risk that you would be most mindful of.
The one blip I'd be a little concerned about is, you talk to LPs around the world and they'll say, I love India, I want to be there, there's just not enough investable opportunity. So it is actually interesting, the industry has become a bit of a barbell. You've got some people on the panel here who are actually out there raising capital, and you have a huge long tail that can't raise any from institutional investors. So that's one thing. In other words, you could end up with India with a highly concentrated manager base that actually represents 60-70%. It could be a market where you have 6 or 7 managers represent 70% of the market. That's one. I don't call that as a risk, but frankly, it does. It creates a concentration that I think for some managers, some LPs will say, look, I love India, but I can't write big enough checks to enough people. The stuff we love about India, obviously, is, I'd say, on a more lighter note, is the optimism. It is very difficult. You walk around the world, you go to Davos, you go to other places, and you listen to conversations inside rooms. There's always this concern about geopolitics. There's always this concern about the drag on, what's going to happen with tariffs, what's going to happen with deregulation. We're getting tied up in knots. Elon Musk is out there trying to remove any red tape he can. And in India, you just don't hear this, right? At some level, it's just amazing. Perhaps we've been beaten into a submission where if nothing changes, we're happy.
Well, that's one way of looking at things. Sumeet, the one thing that you're most confident about, and the one thing that you would be most concerned about.
So I think broad-based economy, which is capitalist at heart, and disciplined capital allocation, I think is a big strength of India and democracy at work. I think complacency and sitting in India, that where else will the world invest?
Where will the money go? Yeah.
So I think that complacency, we have to get out of that and, fight our own battles.
Yes, and I think that's a point that's well taken. Mukesh?
I think I've spoken enough on the positives of India. I hope there's no self-goal. We are known for self-goals. But that's, I think, stable regulatory environment, and that's my, that's the only thing.
And watch the self goals. I think that's an important cautionary message to put on the table as well. Manish?
Again, I'll take a separate crack on the positive. I actually believe, compared to 10, 15 years ago, it's our industry structure and industry conduct. Not just Mukesh, Sumeet, or Deepak here, or Vivek, but if I look around the audience, whether it's the Renukas, whether it's the Chris, Kunals and Sanjays, as an industry, we're working better together, and not the crab mentality of yesteryear. And I fundamentally believe that. I'm not being. There is a thing about industry, and I think the IVCA has played. I'm not selling IVCA, but it's.
No, please go right ahead and do that.
It feels like an industry whose time has come, and we're actually collaborating positively. My worry, I've said before, I remain, is mis-selling to a bunch of naive investors. Illiquid product, which you don't get liquidity for 10 years.
Fair point. Deepak?
I think the positive is generally being net buyer in the market volatility. We actually like it. Disproportionate returns are born out of volatility. So not the destruction of value, obviously don't like that, but generally very positive in the current environment that is coming through. The big worry I have on top of the regulatory environment is just broader geopolitics. We'll have to watch.
Well, so I think, ladies and gentlemen, the view is unanimous. We were looking for a consensus. I think there is consensus on this panel. The opportunities continue to look very robust. There is a pipeline of good businesses, of good business models and good founders that gentlemen like these would want to back. I think we've also put on the table things that we need to be concerned about. And I think that, you know, as a friend of mine always says, that India has the ability to surprise both the pessimists and the optimists at the same time. I hope we continue to surprise the optimists as we move forward. But many, many thanks, gentlemen, for joining us here today. And thank you very much for your insights and your time. Thank you very much, ladies and gentlemen, for joining us this morning.
A big thank you to all the speakers for this very, very insightful session and sharing so many insights on India's investment landscape. I request all of you to please get together for a group photograph.